listen, going back to the IPO, the IPO was priced on the back of very strong demand from global institutional investors, as well as Indian institutional investors, I should add. You can see that in the anchor book demand that we had. Obviously, the way the stock price has performed is disappointing. We understand that a lot of investors are sitting on losses or have taken losses. It's very disappointing for all of them. It's very disappointing for us. The global fintech sell-off really did start end of October. I'm not justifying our share price performance, but I do want to put that in the context of, if you look at when nearly all companies hit their 52-week highs, this was around end of October. And that is really around the time when our anchor round happened. Even by the time we got listed, the stocks were already sliding. And our stock obviously took a big hit in the first couple of days and showed a little bit of recovery. And in the new year, unfortunately, there has been this global sell-off away from growth stocks, which has impacted all stocks as well as ours, right? I think the best thing that we can do, we have had a huge amount of time now to focus on what matters to investors, take all the feedback that investors have given us. And the thing that matters to investors is, number one, we give more disclosure about our business so that they can understand our business a lot better. What are the key drivers in payments, in lending, in our commerce and cloud business, which are the merchant services. So we have given a huge amount of additional disclosure, even if as you look from our prospectus to now, normally companies reduce the disclosure that they have from prospectus to their quarterly earnings. We have actually increased the disclosure because we're very confident about where the business is going. But more importantly, we've taken feedback that, like how we understand our business really well, investors would also like to understand our business really well. And for that, they need additional metrics. And the second thing is, the thing that we have done is really focus on what are the performance levers that matter, which is expansion of revenue, expansion of contribution margin, and reducing EBITDA losses. And I know you said we wanted to get to earnings, so I won't sort of maybe go into that right now. But suffice it to say, on those metrics that matter, and this is feedback from investors, that you need to focus on all three of them. You cannot be talking about one or two of them. You need to be talking about all three of them, and all three have to move in the right direction. So revenue growth, contribution margin expansion, and reducing EBITDA losses. And that's what we want to demonstrate quarter on quarter on quarter. Yes, we made a little bit of a quib about quarters and quarter third, which is the reality of a public company, but that is the reality. It is the reality of a public company that now we have to live with because it choose to be public. So we want to deliver strong results on revenue, contribution margin, and reducing EBITDA losses every quarter.
Okay, so it's great to know how you also think that Paytm needs to be valued, and that is based on the feedback that you have received from your institutional investors. I'm going to ask this question now on behalf of the retail investors, Madhur. Many of them are, of course, viewers of ET Now, who will be looking to this interview to know, yes, they subscribe to the IPO, they have bought shares, they have made losses since then. What's the larger message to them?
No, I think our message is not, our message to institutional investors and retail investors is not different. We're not saying, okay, we only care about this set of investors or that set of investors, right? The feedback that I'm referring to is not just from institutional investors, it's also from analysts who write for retail investors, and the feedback that, listen, what do retail investors care about long term, right? So I just wanted to correct the question a little bit. I was not referring only to feedback from institutional investors. Obviously, it's hard to get feedback from a huge amount of retail investors all at the same time, but the analysts who speak to them are probably the best way to make sure that we tap into. And we've done a lot of work with retail analysts who write for retail investors, who can give us that perspective very, very clearly, which is why for the first time, we have said in our earnings release, as well as in our earnings presentation, which is on the website, that we believe that there's a huge amount of operating leverage in our business. And as a result of which, we expect EBITDA losses to continue to come down. And that is something that some institutional investors were asking and a lot of retail analysts were asking. So our message to them and the feedback that we collect is from everyone. It's not it's not sort of targeted at only one set of investors. I should also point out that the number of retail investors in our company has gone up tremendously, even from the IPO. Typically, companies, from what I'm told and know, typically they see a reduction of number of retail investors that they have. But in our case, even if you look at our website data, which is only on a quarterly basis, but in our case, the data that we get on a weekly basis, the number of retail investors has actually gone up by over 20% since the IPO, and the number of shares held by retail investors has actually doubled since our IPO. So we do see quite a lot of retail interest in our stock, which we are very grateful for. It gives us additional responsibility that we are responsible for performance and financial wealth for millions of retail shareholders in the country.
Oh, so you're saying that Paytm's, the shares held by retail investors has doubled since the IPO, and the retail investors gone up 25% since the IPO. You're way too senior for me to get into specifics of brokerage reports. But what I would like to ask you is that, I'm sure there is some confusion out there when you have reports which are coming in with a target price of 700 rupees a share, which has come in today, all the way to 1800 rupees a share. I know you've touched upon it briefly, but I think this is what viewers will want to know. How should Paytm be valued, on what parameters as well? You talk, for example, about EBITDA margin. For the quarter under review, we've also seen net losses widen because of the ESOPs contribution. And I would imagine, given the kind of fight there is for talent, that's a trend, for example, that's likely to continue.
Yeah. So let me take your question in two parts. First, I'll take the first part of the question about how Paytm should be valued. It's really for investors to decide, and investors have different ways of valuing a company. And obviously, as a company, you have to respect all of that, because you're not out there to teach people, if you will, how they should value a company. They know best because they are investors, and it's their job, and they do their job well. But from what I understand, what I can point to is that we believe what matters is revenue and EBITDA margin. And our revenue has grown last quarter 89% year on year. Our EBITDA losses had come down by 19%. They used to be 63% of sales 1 year ago, negative 63% of sales a year ago. Now they're negative 27% of sales. So when I say that we have confidence that we can continue to reduce our EBITDA losses, I'm saying that both in terms of percentage of revenue as well as in absolute terms. And our EBITDA losses went down from 488 crores to 393 crores. So that is an improvement of about 19% year on year. And we want to, over time, continue to reduce these EBITDA losses. And I think those are sort of the inputs that investors should use in order to value the company, right? Their own valuation methodologies may vary, and they know best because they are the investors. We are a company and an issuer. With respect to ESOP charges, which is the main reason why, while our EBITDA has improved, our net losses from accounting standard standpoint have expanded. I should point out a couple of things. One is ESOP charges are non-cash items, right? So it's not cash that company is paying to someone. In fact, because you're compensating in shares to your employees, that's why you have to take this non-cash charge, right? So that's the first point. And the second point is, and this I feel very confident about, the way nearly every investor values ESOP payments, if you will, is they don't take the P&L charge. So they keep it they look at EBITDA rather than EBITDA after ESOP cost. And then, but what they do, and the investors should do this, if take a fully diluted share count number, which is to say that how many shares does Paytm have? It's not 650 million, it's actually 695 million, because that includes all the ESOPs that have been issued and all the ESOPs that are currently authorized to be issued. So even the ESOPs that have not been issued and are authorized to be issued, investors add that and say, okay, Paytm, you have actually 695 million shares. So if we think that you're worth X, then I'm going to divide that by 695 million rather than divide that by 650 million to get to the share price. But actually the valuation metric is EBITDA, whereas the number of shares one should use is 695 million. And as long as you've used 695 million shares outstanding for Paytm, then you should be looking at EBITDA before ESOP cost, because that is the cash number. That is the cash loss. That is the best proxy, if you will, for cash losses that a company has.
Okay, so that's how to look at it, is, despite the ESOP cost that has come in. Now, Madhur, very recently we had Mr. Rakesh Jhunjhunwala on the channel, in fact, a day after Union Budget. And while talking about new age companies like yours, he did say valuations are a slave of earnings. That's the long and short of it. That's the way to look at it going forward. My question to you is, and you have talked about EBITDA margins that will be going up and all of that, and losses that will be narrowing. The road to profitability, how can that be achieved? Let me put it this way, when will that be achieved? When will Paytm enter the green? Because maybe we're also entering a new era where easy money may be behind us or being wound down.
Yes, so there's no doubt that long-term companies should make profits and should make lots of profits, right? So companies have to define for themselves that this is the investment phase and this is the sort of monetization phase, and then this is the highly profit-generating, earning-generating stage, right? So where Paytm is right now is we are in the very high and expanding monetization phase, right? So again, if I go back to the earnings, we grew 89% year on year. There are not that too many companies in the world. In fact, I'm aware of almost zero companies in the world that grow 89% in revenues year on year on a base of roughly $200 million or roughly 1,500 crores a quarter, right? So there are almost no companies listed in India or anywhere in the world that grow at that kind of pace, right? So we're quite proud of that, because there is 89% revenue growth in a world where people say, okay, payments, will it make money or not? Well, our payments business has grown 90% year on year in revenues, because one of the skepticism, if you remember, investors had was whether payments can continue to make more and more money over time. We have shown that we've expanded our payments revenue by 90%. We have expanded our lending business dramatically, over 4x growth rather, year on year on our lending business. Our revenue from lending has gone up by 3x. So we have seen this massive expansion of our platform, but not just expansion of our platform, but also an expansion of revenues on our platform. And that is coming incrementally at very high profits, right? So if you see our contribution profit, it has gone from 9% of revenue to 31% of revenue. So what you can see is that the company is monetizing more and more. The company is generating a significant amount of contribution profit, and it is reducing our EBITDA losses, which means that if we continue on this trajectory, then we can generate a huge amount of earnings long term, right? And that's the trajectory that we wanted to put the company on. And we believe that we are on that trajectory. I know some investors may want us to get to that point sooner, and some investors are okay for us to invest for some period of time before we get to break even. So we have to triangulate that. With respect to your question on specifically when we would get to break even, Nandra, we have not given that sort of statement out in the public domain in our earnings release. So I'll refrain from doing that right now. But suffice it to say, we're thinking very hard about how do we get this business to reduce EBITDA losses significantly over time. And that's a focus that you'll start seeing in our results, right? You've seen one phase of that, of a reduction of roughly 100 crores of EBITDA losses per quarter. And you'll continue to see our focus on that pay off.
You said in the interview that one of the feedback is to have more disclosures, right? Now, in the disclosures with this earnings, you have been categorically stated as lending is done in partnership with banks and NBFCs, and no first loan default guarantee is given, unquote. What are you basically trying to say? That all the money that you have raised, whether it is from a Berkshire Hathaway to an Ant Financial to a SoftBank, is not being used for lending? Is that basically what you're saying, that you're not growing your business on the back of VC funding? Or rather lending, sorry, I mean.
No, that's not quite what we're saying. What we're saying is there are RBI guidelines tell technology companies like us that we can do certain sorts of things, which is to provide distribution services, technology services, collection services. And there are certain things that we should not do, which is take capital, take credit risk, do underwriting ourselves, and so on. And we have followed those guidelines to the T. We look through those very, very carefully. We work only with tier one partners who also will obviously never compromise. It is our understanding, never compromise on compliance standards. And as a result of these, we also don't give first loss default guarantees. So our business model is that our partners do the underwriting, they take the risk, they use us for distribution and collection and building great technology for the customers. And that's the model that we are comfortable with, right? So that's what we were trying to explain in that. And we believe that the advantage of that is that it is one, a win-win solution. So our partners win and we win together. The second is it is very scalable because our partners are very large partners. So it's very scalable because obviously they have very large balance sheets. And the third and most important perhaps is that it's regulatory compliant. And when it's regulatory compliant, not in the gray area, then it is also very scalable because you don't run the risk that the regulators could come and point out problems with the way you are doing business. So we want to follow the regulations in letter and spirit, and that's what we were trying to say there.
A final question, Madhur. Do you, Vijay Shekhar Sharma, the top management of Paytm, regret going in for the IPO? Life must have been simpler pre-IPO.
No, we don't regret going for an IPO. Clearly, doing an IPO and then facing these sorts of markets is a challenge, but we learn from it. We learn from it very quickly. We learn how to factor in investor expectations into our performance, and whether it is with respect to certain type of performance or whether it is with respect to certain type of disclosure. We learn to be a company that is very transparent to our shareholders. We learn to be a company that can be in the public eye and have a lot of opinions about the company and distill all of that while staying true to our mission, which is that we want to expand financial access for hundreds of millions of Indians, 500 million Indians, as we have put in our mission statement, while delivering extraordinary financial performance. And I just want to go back to the quarterly results, given this is the last question. Our quarterly results last quarter have been nothing less than extraordinary. 89% revenue growth, a huge 6x increase in contribution profit, and 100 crore reduction in our EBITDA losses. That shows the power of our platform. And these are absolutely extraordinary results.